A home equity line of credit is a very powerful tool to use to build substantial wealth for you and your family if used correctly to buy cash flowing assets. But in today's video, that's not at all what we will be talking about. I will be going over exactly how not to use a home equity line of credit so you don't get stuck in a financial pickle and potentially lose your house. First things first, a home equity line of credit is a revolving line of credit that you get from accessing the equity inside of your home. Think of it very similar to a credit card where you can draw from it, pay it back, and then draw from it again. But the one thing is there's a variable interest rate that is based off of the prime rate of the market. The amount that you can borrow is based off of the equity that you have inside of your house, and just remember that you have to pay back the principal and interest on the money that you use. So let's get into exactly how not to use a home equity line of credit. And for more real estate investing videos like this, consider going down and subscribing to my channel. The first mistake that people end up using their Heloc for is for non-essential or luxury purchases. Now this could mean a lot of things, but just a couple examples for you is buying that brand new shiny car, going on that vacation you've always wanted to, or buying jewelry. Now remember, a home equity line of credit is a lien against your house. So if you do not pay that back, say goodbye to your house. That's why if you use it for non-essential purchases like luxuries, then you could be getting into unnecessary debt and more financial stress than you actually need. And I'd be lying if I said that I never thought about taking the Heloc from one of my properties to go and buy something nice for my wife and I so that we can have a better quality of life. But for a Heloc specifically in a variable interest rate, you really don't want to get caught into a situation where you can't pay back the money you used. But let's just say you end up going and purchasing that very nice car that you've always wanted. That's all great, but you're in the same financial situation you were in, except you now have a large monthly payment that you have to contribute to on top of your other expenses that you have to pay every single month. Now, when I say a luxury, I mean anything that you purchase that puts you further in debt and does not pay you back in form of cash flow or by appreciation. And you may argue back and say, hey, you know what? I deserve this. I work extremely hard. And I'm not saying that whatsoever. Why would you want to work extremely hard to go further in debt so that you have to work even harder than what you did originally? Next is don't use a home equity line of credit to pay off debt. Now let me explain. When you are paying off debt with a home equity line of credit, you are basically buying debt for debt. And you may say, you know what, the home equity line of credit has a lower interest rate than the debt that I am actually paying off, and it's going to end up being good. But just make sure that you think about this because there is a variable interest rate on a home equity line of credit, and you may buy out the debt that you already had at a 5% interest rate, but it may rise to a 7 or 8% like we're seeing in today's market because of the prime rate adjusting. Meaning, just because you borrowed money from the Heloc for 5% doesn't mean it will adjust and go up. You may actually have to be stuck with paying off the Heloc at a 7, 8, or 9%, way higher than what you originally thought and what you accounted for. This is exactly why I tell everyone that a home equity line of credit should be used for shorter term debt, meaning about 1 to 3 years where you can actually pay that off in that short amount of time. Because the more time you wait, the more interest you could potentially be paying on that. But by consolidating higher interest debt into lower interest debt, it only works if you stop incurring additional debt. If you continue to rack up credit card debt, it's not going to help you at all, and you may be stuck losing your house because you can't pay back the lien against that house. Now, the next way is borrowing more money than you can actually afford, and let me explain. When you are taking out a Heloc or any loan to begin with, you really want to understand your financial situation and what you can actually afford. Don't let the amount that you're actually pre-approved for sway you from thinking that you can afford it because you got pre-approved for that amount. One way that you can actually figure out how much you can afford is by making 2 lists. The first list will be your income. This is where you will include everything from your W-2, 1099s, anything that you bring in every single month. You would calculate that and figure out the total amount of money that you bring in every single month. The second list would be your expenses list, and that would be everything that you pay for. For some examples, it would be your car payment, your car insurance payment, your phone bill, the amount of your rent or mortgage right now. You would make a list of that. After finding the amount for both lists, once you take the total of your income, subtract the total of your expenses every single month, that's what you call your excess cash every single month. What I suggest with doing with your excess cash is putting a percentage away for a rainy day, meaning your savings, and then put a portion away for you so that you can enjoy and have some type of quality of life. And from the amount that's left over, you should gauge of how much you are able to afford and what you feel comfortable paying for in terms of a loan every single month. If you take anything away from this video, I really want you to understand that the interest rate on a Heloc is variable, meaning that it changes. Just because you take out a certain amount at a 5% interest rate doesn't mean it won't fluctuate with the market and go up. Then you are stuck paying more interest than what you originally thought, and it may be too high of a payment to where you actually can't afford. And at that point, you feel like you're in a hole that you can't get out of. And that's not just a personal loan that you're taking out, it's a loan against your house. So if you don't pay that back, you say goodbye to your house. Like I said at the beginning of this video, a home equity line of credit can be a very valuable tool, but when you use it irresponsibly, it can turn into a huge liability for you. Avoid the mistakes that we talked about in this video and use your home equity line of credit wisely. Don't forget to like and subscribe, and if you enjoyed this video, make sure to check out this video, which is how I was able to purchase a cash flowing asset with my home equity line of credit. Thank you for watching, and I'll see you in the next one. Happy investing.